Good day, and welcome to today's WELL Health Technologies as part of the Planet MicroCap Showcase. It is now my pleasure to turn the floor over to your host, VP of Investor Relations, Pardeep Sangha of WELL Health Technologies.
Hi, welcome everyone. This is, as the operator mentioned, my name is Pardeep Sangha. I'm in charge of Investor Relations at WELL Health. We have our CEO, Hamid Shabazi, will be joining here shortly as well. For those of you unfamiliar with WELL Health, I'll just begin here and then Hamid will join in. Here's our disclaimer, which you can find on our investor website as well. WELL Health is a Vancouver-based Omni-channel digital health company. We are really a capital allocator, and what we've done is we made a number of acquisitions in the healthcare space. We're really investing in the future of healthcare in Canada and North America. Sorry, the slide just switched back. So a couple of key things for our company is that we have our CEO is named Hamid Shabazi, who's previously founded a company called TSX Networks, which was sold to PayPal in 2017 for over $300 million. We've had a strategic investor, Sir Li Kai-shing, who many of you may have heard of. He's one of the 50 richest persons in the world, one of the richest persons in Asia. And then also more recently, I wanted to talk about our acquisition of CRH Medical, which is announced on February 8th, and that's a provider of anesthesia services in the U.S. So that really enters into the U.S. market. And with that, I'm going to turn things over to our CEO, Hamid Shabazi, who can take you through the rest of the presentation. Hamid?
Thank you, Pardeep. It's a pleasure to be with you all. I'm sure we've encountered each other along the way as I've been giving quite a few of these presentations. I'm going to really tailor the presentation in such a way where you can learn about WELL, but also get a quick update as well. As Pardeep noted, we have been quite active and actually today are expecting to close off our CRH medical acquisition, which is a really big event for us. It's something that we want to talk about. This is our largest acquisition to date by far, well over 400 million Canadian in enterprise value. I think actually over 450 million Canadian in enterprise value. CRH Medical is a healthcare healthcare company with a medtech device and anesthesia services that it provides to over 3,000 doctors, mainly in the United States, that are GI doctors. It'll operate as our seventh distinct business unit. It based on its Q4 revenues, it was recently a New York Stock Exchange listed company, and in its recent quarterly earnings in Q4, it had produced more than $16 million US in EBITDA, and that was essentially a 44% EBITDA margin on its top line. So, very, very strong results. We're expecting more than $40 million US in free cash flow from CRH Medical post-transaction. That's before leverage and interest costs, leverage, interest, and tax costs. And so if you look at the company's, can you guys see the screen, the business unit slide, Pardeep?
Yeah, that's the one. Discipline and Accretive capital allocation. That's what the slide everybody's on.
Perfect. Yeah. So there are 6 other distinct business units today in the business. Stepping back, the whole point of WELL has been to invest in the future of healthcare. And so healthcare being, a $250 billion business in Canada, a $3 to $5 trillion business in the United States, depending on how you size it, it is often the largest part of any services economy, largest sector as part of any services economy in the industrialized world. And yet it has been lagging behind other sectors as it relates to digitization and modernization. That was the whole reason for starting WELL, because we saw that there was an anomalous lack of digitization occurring with this sector overall. And actually even more anomalous was how Canada as a a very digital country generally, was lagging behind. Of the 40 countries that have modern medical systems, it was really in kind of the last quartile in terms of its digital posture. And so we started in Canada because it seemed that digitization was really lagging, and we quickly became the third largest operator of medical clinics in the country. We bought a number of medical clinics in our home state of British Columbia, and we started to apply all kinds of different software workflow and digitization techniques. We also started to acquire our way into digital technologies. So you see the business unit EMR service providers. That stands for Electronic Medical Records Service Providers. So an EMR is essentially the ERP system or practice management system that a medical practice would use to manage their entire practice. So it's pretty substantial. And about now we have about well over 15% of all doctors in Canada in outpatient clinics use WELL's software to run their practice. As you can see, we've made numerous acquisitions in order to make that happen, and we applied those technologies and that expertise in our own health clinics, and the results have been fantastic. I mean, we have essentially doubled the EBITDA in one portfolio we bought 2.5 years ago, another one about a year and a half ago. We've essentially doubled the EBITDA of that portfolio just by really leveraging technology and applying a lot of software workflow standardization. And so we're very pleased with that. The hypothesis when we were going into this business was that doctors were running these clinics and they were not optimally managed and digitized. And that thesis is really bearing through, and that's a very exciting opportunity for us. We believe that there's a big opportunity to continue to acquire and transform clinics into a more digital posture. We then got into digital apps. So that's our business unit that focuses on platform technologies. What I mean by platform technologies is yes, we've been buying software platforms. So we have essentially two software platforms, two Canadian-based telehealth platforms, Insig Corp and Adricare, and one U.S.-based telehealth platform. And then we made two minority investments, one in Felix AI, which is workflow optimization AI-driven company, and Pillway, which is e-prescription fulfillment. So we already have very strong digital technologies that we either own or have strategic alliances with meaningful ownership, and we've been cross-pollinating and leveraging those across our business units. So our EMR service providers now offer telehealth by virtue of our investments there. Our health clinics, our allied care division, all use our technology. So it's very, very exciting. What's also, stepping back, what's really unique about WELL, oftentimes you see companies in healthcare that either are platform technology companies, meaning that they provide services and software to healthcare practitioners and charge them a SaaS fee, or they have what's called patient services revenue, meaning that the physicians work specifically within the company. What's unique about WELL is that we have both. So we have hundreds of doctors that work at WELL clinics every single day, and we also have thousands of doctors that use our software. And when you actually combine all of the different patient services that are delivered through our platform technologies, not even including our EMR, just from a telehealth and patient services perspective, we're nearing about 500,000 visits per quarter, which means millions of a run rate of essentially a couple million visits per year, which to our knowledge qualifies us by far as the largest multi-channel and omni-channel service provider in the country, clear across the country, with our telehealth and in-clinic physical assets. Allied Care is a division then we started, which is very exciting. It's basically all matters and factors of healthcare that do not involve a medical doctor. So this could be sleep technicians, physios, clinical counselors, mental health counselors. This is an area where not only have we enhanced, so without exception, we've had the assets in that division also grow in EBITDA. Why? Because we've not only helped them grow with additional capital, but we've integrated them with our other assets and cross-fertilized with our healthcare clinics. So now when you go into one of our healthcare clinics, sleep technicians are there. We have allied health practitioners there, and there's referrals essentially occurring from our physician population. We then have bought a couple of cybersecurity companies. One of the big themes in the future of healthcare, in our opinion, is as more and more healthcare data, that very, very valuable healthcare data comes online, it will need to be protected because of its value. Healthcare is the most breached sector in North America today. It is very expensive. There's more and more regulation coming online that holds clinicians, doctors, and clinic owners accountable to protecting that data because it's just so important. And so this is now a $20 million plus profitable growing business for us. And we expect to continue to consolidate and acquire more assets in this area. And again, we have an incredibly sophisticated team that run this business unit, people who have been essentially operating at the highest levels of security for some of the largest hospital systems in the country. We then acquired the last business unit until CRH, which we just talked about, was our billing and back office division. We bought a company called Doctor Care, which is the largest provider of outsourced billing to Canadian doctors in the country. So if you're a doctor, you don't want to do your own billing because it's really complicated. There's a lot to know. You can get in trouble if you do it, incorrectly. You hire Doctor Care, and they've done a great job for many doctors. They have very steady recurring revenue, and that's what's really interesting. We have recurring revenue in billing and back office. We have recurring revenue in cybersecurity and one-time revenue. We have lots of recurring revenue in our digital apps division. The Insig Corp company there has a brand called Tia Health, which is one of the largest telehealth companies in Canada. It's an Uberized model where doctors can essentially add themselves to the pool of physician supply to handle patients that come in online and look for doctors. EMR is essentially almost all of recurring revenue. Allied Care, there it's more episodical revenue, but there's a high reoccurring cadence to this business, as in our clinics as well. So we have incredibly resilient revenue. As we saw during the pandemic, WELL not only continued to grow, but actually thrived. And even now, post-pandemic, even though the pandemic is still around, even as that's certainly occurring and people are getting vaccinated, that acceleration and that growth continues for our business. So this kind of, what's really unique about the business again is these aren't just a group of assets that were, bought and struggling to integrate. We have 6, soon to be 7 management teams and CEOs. We're decentralized structures. So think about, Berkshire Hathaway. Think about, that's the model here. It's a holding company that invests in, very high performance operating teams. We bring in companies that don't need to be fixed, that are thriving, that are doing well, that are focused and have a track record for growth and profitability for the most part, unless they're earlier stage like some of our digital apps. And we empower them to continue to grow. So kind of moving on here to the CRH acquisition. As you can see, on a run rate basis, this is actually, the numbers are actually better than this because the Q4 numbers for CRH are inferring a better than $180 million run rate, but consensus estimates were about 175 prior to their Q4, so that's what we have here. But as you can see, WELL's pro forma now is very much post-CRH, which should essentially be tomorrow, will be a $300 million revenue company generating roughly, $80 million in EBITDA. And a lot of the EBITDA that's generated by CRH is they have some non-controlling interest, meaning that they buy a lot of companies in control transactions at 51 or 58%. And And so if you remove those non-controlling interests, that's where the free cash flow, that's the bridge from 72 to 45. So as you can tell, we are expecting roughly 50 million plus. This is actually analyst expectations of WELL now. So free cash flow margins of more than 18%. So we're just thrilled. I mean, if you look at how accretive this acquisition was for us, on a per share basis, we're seeing accretion of 120% plus on the revenue line, and 800% EBITDA accretion on a per share basis. So again, when you talk about acquisitions, a lot of people issue a lot of stock. They go through a lot of dilution to grow their revenue and EBITDA. But the key is per share accretion. And here we're delivering 120% per share accretion on revenue and 800% on EBITDA. So this is remarkable because we only overall are taking on 17% of dilution for the whole transaction. And how did we do that? How did we buy close to $500 million Canadian asset? We did that by raising equity at 25% premium to market at the then 5-day VWAP price, so $9.80 from a group of incredible investors led by Mr. Li Ka-shing and his partner, who put in $100 million at $9.80, and then 8 other large financial institutions, mostly in Canada, one in the U.S., that invested $202 million, and I should say $201.5 million, because then there was $1 million that came in from WELL's own management team, with me putting in $530,000 of my own capital. And then all of our board members and most of our management team also participated. And then what we did is we, for the balance, we levered the target itself, because JP Morgan Chase provides a $200 million credit line to CRH. And if you want to know if a company has strong cash flows, look and see if large, tier one banks will lend them money. And this is the biggest indication. And so we are thrilled to say that we didn't even have to use any of our own capital. So our cash position is still very strong, and we're well positioned to continue to allocate capital. We have 10 signed LOIs. With those LOIs, the company's revenue actually, we think on a run rate basis will, again, with these signed LOIs, will take us closer to $400 million in revenue and over $100 million in EBITDA by the end of the year on a run rate basis. But those figures obviously have not been integrated into consensus estimates, which is what you see here. As you can tell, our 2019 actuals were 32.8. Then we did 50 last year. You can see that it was a break-even year. So even though we're growing quite a bit, we're acquiring, we're growing, we pretty much broke even in 2020, and our Q4 was profitable. And now you're seeing this, quantum growth in both revenue and EBITDA. And this doesn't even include all our other LOIs, which we are fully funded for. So it's really, truly remarkable that as investors, because of all this, cross currents and challenges in the market in the last few weeks and months, a couple of months, investors right now have an opportunity to buy at a 30% discount to those incredible institutions and Li Ka-shing, who invested at $9.80. So, we are very comfortable with that price. We think that as things kind of come back to normal and people start to see us publish these results, we believe this is a fantastic opportunity for anyone that comes in. And this also paves the way for our own U.S. IPO, which we are planning to do in basically Q4 of this year. Provided the markets look fine and everything is going in the right direction. Why are we looking to do that? Well, pro forma now, with our current stock price, we're trading less than 6 times sales when you consider pro forma, the company's revenue and so forth. And the comps in the U.S. are higher than 11. I think they've come off a little bit, but I believe they're still about 12 or 13. And so, we are now at the quantum, at the numbers that would make sense for us to be, as part of that pool of U.S. companies, because now a majority of our revenue is U.S. based. So we have just an incredible opportunity here, and another Canadian company about 14 months ago, you probably heard of them. Lightspeed was about our market cap range, 1.2 billion or so market cap. They did 2 larger acquisitions and a U.S. offering, and they're a $10 billion market cap company now. And so we will actually have better numbers than Lightspeed with our CRH Medical, our LOIs, and so we think there's enormous market cap potential growth for us. And actually, if you look at the next slide, we are, again, one of the great things about this business is that management and shareholders are so incredibly aligned. Personally, I put more than $6 million of cash into the company. I've never taken a dollar of cash from the company. All of my salaries being converted into restricted stock, and I've never sold a share. And I've invested at every round personally, as have most of our management team. Anytime we've been invited. So for example, our September 2020 private placement. Management was not invited to participate. So we just raised $23 million from Lee Cushing and a group of people related to him. You can see that was at $4.77. And you could see that he started investing right at the very beginning at 33 cents. And in May 2018, at the same time, I invested a couple $1 million at that time with him as well. So you just don't see this very often. This kind of alignment, this kind of this kind of incredible support. And beyond Lee Cushing, we have shareholders like Manulife Financial, which is a $1 trillion asset manager, major banks. But really just summarizing, we have truly unique group of assets, incredible managers and leaders, a decentralized structure and operating model that has been heavily inspired by Berkshire Hathaway, Constellation Software, Enghouse, some of the best capital allocators in the world. We are investing in growth areas. Everything that we invest in, we believe, is improved by technology. That's the whole idea of tech enablement. And so we will continue to have strong organic and inorganic growth. And happy to take any questions if anyone has any.
Hamid, I'm just reviewing the questions here. We have a question here around the acquisitions. If you can talk a little bit more about your acquisition pipeline.
Sure thing. Yeah. So if you look at that business unit slide again, basically the acquisitions are reflective of this genre of company. So we're going to be continuing to consolidate companies in each of these business units. And people ask, well, how can you do all these acquisitions? How can you integrate them? Well, because we have 6 and soon 7 management teams that integrate these assets, because that's the whole point of WELL, is that there's a number of things that are decentralized and a number of things that are centralized. So we don't integrate an asset, we don't buy an asset unless it already fits into one of our business units. And a lot of times we're buying assets at more than 50%, but not 100%. So we're actually maintaining the integrity of the company and continuing to have them operate as is for a number of years, in which case there's very little integration that needs to occur at all. But yes, we have acquisition prospects clear across these specific business units. So they're a mix of clinical and digital.
We have another question here. It comes in from Randy. He's asking about your U.S. IPO plans, the U.S. listing, timing on that, and process.
Yeah, so we think that as early as fall, we could be ready to go into the U.S. We have, what's really exciting is we have all the major tier 1 investment banks in the United States interested in talking to us and, really kind of competing for this business. So this is not something that would be done with, 2nd and 3rd tier investment banks. This would be done with tier 1 investment banks And as you're probably aware, the key is with these IPOs is to bring in the most powerful analysts that are really part of these big banks that drive the momentum with the largest institutional shareholders. And so that's our plan. But we'll be heading into that with having published already some phenomenal results as a result of the growth in revenue and EBITDA that comes from our CRH acquisition and the other acquisitions.
Any last closing comments you might add, Hamid, as we wrap up here?
I think this is just a really interesting time to be looking at the company. I know we've been talking about CRH now for a few weeks as a result of announcing the deal on February 8th, but a lot of people thought because of the incredible price we got, based on what we have as an internal case, we're basically buying this company for less than 8 times cash flow and less than 6 times EBITDA. Most people thought we would have a new bidder, and that didn't materialize, I think, because of some of the challenges in the market over the last little while. And, so when this actually gets consummated, which should be, again, in the next 24 hours, I think it just provides a really unique opportunity for shareholders to invest, at a deep discount as compared to, one of the greatest investors of all time, Li Ka-shing, and a lot of other incredible funds who have a combined assets under management of about $500 billion. So think to yourself, do you think a company that's growing at this rate with this level of profitability is going to stick around here at 5 times sales? I think not. And so, great opportunity. We hope you take advantage of it. And Pardeep and I are here to answer any of your questions. And if you are a shareholder, know that we appreciate you. We have great gratitude for the support that we've received. And we look forward to continuing to do things that advance shareholders and shareholder interests. Thank you.
Thank you, everyone, and I'll pass it back over to the operator.
Thank you. This does conclude today's webcast. Thank you for your participation, and have a wonderful day.